Hello again, fellow BeachBum traders. Thank you for joining us for our video on tax loss harvesting and how it works. We'll provide you with a lot of information about what is tax loss harvesting, also referred to sometimes as tax loss selling, and how does that work. We'll also share with you some examples, some pitfalls to avoid, how tax loss harvesting works for average investors. We'll provide you with a complete guide to tax loss harvesting with ETFs and how to avoid violating the wash sale rules when realizing tax losses. And also please stick around to the end of the video and we'll talk about some specific trading strategies in terms of tax loss harvesting, tax loss selling, the wash sale, as well as positioning for a potential Santa Claus rally in a given year. So again, please stick around to the end of the video and we'll share with you some additional trading strategies on how to apply all of this information about what is tax loss harvesting and how does it works, so you can make money trading and succeed in your trading career. So let's get started.
Tax loss harvesting, how it works, example, and pitfalls to avoid. What is tax loss harvesting? Tax loss harvesting is the timely selling of securities at a loss in order to offset the amount of capital gains tax due on the sale of other securities at a profit. This strategy is most often used to limit the amount of taxes due on short-term capital gains, which are generally taxed at a higher rate than long-term capital gains. However, the method may also offset long-term capital gains. This strategy can help preserve the value of the investor's portfolio while reducing the cost of capital gains taxes. If your capital losses for the year exceed your capital gains, you can deduct up to $3,000 in net losses from your total annual income. However, you cannot deduct more than your total capital losses for the year. If your net losses exceed $3,000, Internal Revenue Service (IRS) rules allow the additional losses to be carried forward into the following tax years. Key takeaways: tax loss harvesting is a strategy investors can use to reduce the total amount of capital gains taxes due from the sale of profitable investments. The strategy involves selling an asset or security at a net loss. The investor can then use the proceeds to purchase a similar asset or security, maintaining the portfolio's overall balance. The investor must be careful not to violate the IRS rule against buying a substantially identical investment within 30 days. Understanding tax loss harvesting. Tax loss harvesting is also known as tax loss selling. It can be done at any time of the year, but most investors wait until the end of the year when they assess the annual performance of their portfolios and its impact on their taxes. Using tax loss harvesting, an investment that shows a loss in value can be sold to claim a credit against the profits that were realized in other investments. For many investors, tax loss harvesting is a critical tool for reducing their overall taxes. Although tax loss harvesting cannot restore an investor to their previous position, it can lessen the severity of the loss. For example, a loss in the value of security A could be sold to offset the increase in the price of security B, thus eliminating the capital gains tax liability of security B. Using the tax loss harvesting strategy, investors can realize significant tax savings. Maintaining your portfolio. Dumping a loser in a portfolio obviously has advantages. However, it inevitably disrupts the balance of the portfolio. After tax loss harvesting, investors who have carefully constructed portfolios replace the asset they just sold with a similar asset in order to maintain the portfolio's asset mix and expected risk and return levels. Beware, though, of buying the same asset that you just sold at a loss. IRS rules require that an investor waits for at least 30 days before purchasing an asset that is substantially identical to the asset that was sold at a loss. If you do so, you lose the ability to write off the loss. This is the dreaded wash sale rule. Short-term losses can only be used to offset short-term capital gains tax. Long-term losses can only be used to offset long-term capital gains tax. The wash sale rule. The wash sale rule is straightforward for the average investor, who merely has to avoid buying the same stock he or she just sold at a loss for tax purposes. The rule, however, is designed to address more esoteric strategies involving tax loss harvesting. A wash sale is a transaction involving the sale of one security and, within 30 days, either before or after the sale, purchasing a substantially identical stock or security, either directly or indirectly via a derivatives contract such as a call option. If a transaction is considered a wash sale, it cannot be used to offset capital gains. Moreover, if wash sale rules are abused, regulators can impose fines or restrict the individual's trading. The wash sale rule in ETFs. One way to avoid the wash sale rule is by using ETFs in a tax loss harvesting strategy. Because there are now several ETFs that track the same or similar indexes, they can be used to replace one another while avoiding violating the wash sale rule. Thus, if you sell one S&P 500 index ETF at a loss, you can buy a different S&P 500 index ETF to harvest the capital loss. Many robo-advisors offer free tax loss harvesting in a way that is automated and will not violate the wash sale rule. Example of tax loss harvesting: assume an investor earns income that puts him or her into the highest capital gains tax category. For the 2021 and 2022 tax years, that means more than $445,851 if single and $501,851 if married, filing jointly. The investor sold investments and realized long-term capital gains, which are subject to a tax rate of 20%. Below are the investor's portfolio gains and losses and trading activity for the year. Portfolio: Mutual Fund A, $250,000 unrealized gain, held for 450 days. Mutual Fund B, $130,000 unrealized loss, held for 635 days. Mutual Fund C, $100,000 unrealized loss, held for 125 days. Trading activity: Mutual Fund E, sold, realized a gain of $200,000. Fund was held for 380 days. Mutual Fund F, sold, realized a gain of $150,000. Fund was held for 150 days. The tax owed from these sales is tax without harvesting equals $200,000 by 20% plus $150,000 by 37% equals $40,000 plus $55,500 equals $95,500. If the investor harvested losses by selling mutual funds B and C, the sales would help to offset the gains and the tax owed would be, tax with harvesting equals $200,000 minus $130,000 by 20% plus $150,000 minus $100,000 by 37% equals $14,000 plus $18,500 equals $32,500. How does tax loss harvesting work? Tax loss harvesting takes advantage of the fact that capital losses can be used to offset capital gains. An investor can bank capital losses from unprofitable investments in order to pay less capital gains tax on profitable investments sold during the year. This strategy includes using the proceeds of selling the unprofitable investments to buy somewhat similar but not substantially identical investments that preserve the portfolio's overall balance. IRS rules prohibit an investor from buying the same investment within 30 days if the loss is used to offset capital gains taxes. What is a substantially identical security and how does it affect tax loss harvesting? In order to make use of tax loss harvesting, the investor cannot violate the IRS wash sale rule. That is, the investor cannot sell an asset at a loss and buy a substantially identical asset within the 30-day period before or after that sale. Doing so will invalidate the tax loss write-off. A substantially identical security is defined as a security issued by the same company, e.g. its Class A shares versus its Class B shares, or a convertible bond issued by the company, or a derivative contract issued on the same security. How much tax loss harvesting can I use in a year? The IRS limits the maximum amount of capital losses that can be used to offset capital gains in a year. An individual taxpayer can write off up to $3,000 in net losses each year. When capital losses exceed $3,000, the excess can be carried forward to future years. For example, a $9,000 net capital loss can be spread over 3 tax years. Correction, Dec. 3, 2022. A previous version of this article incorrectly described the IRS rules for deducting short and long-term capital losses. For both short and long-term losses, you can deduct up to $3,000 in net capital losses every year, not $3,000 in total losses. How tax loss harvesting works for average investors. Tax loss harvesting (TLH) is a strategy to lower current taxes paid to the U.S. federal government by deliberately selling an investment at a loss, i.e., deliberately taking a capital loss, in order to use that loss to offset taxes owed on an investment sold at a profit, i.e., a capital gain, or even taxes owed on personal income. The investment can be any tradable security, stocks, bonds, shares in an exchange-traded fund, or even cryptocurrencies. Tax loss harvesting is relevant only for taxable investment accounts, and the benefit is tax deferral, not tax cancellation. Although the Internal Revenue Service (IRS) allows the deduction of capital losses to offset taxes owed on capital gains, both advocates and critics of tax loss harvesting agree that it is only appropriate for certain taxpayers in certain scenarios, and both agree that all taxpayers should consult an investment tax professional before attempting TLH. Advocates position the technique as a hedge against market downturns, a shrewd way to turn a negative into a positive. Critics caution that executing tax loss harvesting correctly requires expertise and that the strategy can easily backfire, even on investment professionals. Key takeaways: tax loss harvesting is a strategy to lower current federal taxes by deliberately incurring capital losses to offset taxes owed on capital gains, or even taxes owed on personal income. Tax loss harvesting only defers tax payments, it does not cancel them. If an investor has no capital gains to offset in the year the capital loss was harvested, the loss can be carried over to offset future gains or future income. There is no expiration date. For small investors, one study found that tax loss harvesting delivered a wide range of outcomes, with 40% of the variation driven by uncontrollable factors in the return environment and 60% driven by individual differences in the investor profiles. Advocates position tax loss harvesting as a shrewd way to turn a negative into a positive. Critics caution that tax loss harvesting requires expertise and that the strategy can easily backfire, even on investment professionals. Capital losses to offset capital gains and personal income. A capital gain, or a capital loss, is the difference between the cost basis, what a taxpayer paid for an investment, and the sale price, what they later earn when they sell it. For example, as soon as an investor sells stock with a cost basis of $25,000 for $27,000, they have realized a capital gain of $2,000, and that gain is taxable in the year they sold the stock and took the profit. This is where the IRS-approved strategy of tax loss harvesting comes into play. The investor who realized a capital gain of $2,000 can deliberately sell one of their other investments at a loss to offset the gain on their tax return. For example, if the same investor had another stock that they bought for $30,000 and then sold for $25,000 when the price dropped, they can harvest that price difference of $5,000 as a capital loss. For tax purposes, a capital loss is not considered realized until the investment has been sold for a price lower than the cost basis. Not only can capital losses offset capital gains, but, if losses exceed gains that year, the investor could also use the remaining capital loss balance to offset personal income, or even carry the loss over to offset gains in future years. Although tax loss harvesting can be, some say should be, done throughout the year, the most common time is year-end, when annual income taxes are looming. Of course, December 31st is the deadline to take the capital losses that will be used to offset capital gains for that year, so that adds to the urgency. However, according to advocates, the danger of waiting until year-end for all TLH trades is that a capital loss that was available to be harvested in June may no longer be available in December. Tax loss harvesting only postpones tax obligations. Tax loss harvesting is relevant only for taxable investment accounts, and it is important to remember that the benefit of TLH is not that the tax obligation is cancelled. The benefit is the same one offered by tax-deferred accounts, the tax obligation is postponed. The rationale behind tax loss harvesting is that deferring current tax payments allows investors to use the savings to fuel portfolio growth in the present, and the assumption is that the dollar amount generated over the years will be significantly more than the eventual tax bill when it comes due. The lower the cost basis, the higher the tax bill. Another important consideration for investors is that, although tax loss harvesting can reduce the tax bill due this year, the process automatically lowers the cost basis of the investment, which could result in a higher bill on future capital gains. As explained above, a capital gain, or a capital loss, is the difference between the cost basis, what a taxpayer paid for an investment, and the sale price, what they later earn when they sell it. When the cost basis goes down, capital gains go up, and so does the future tax bill. Here is an example of how tax loss harvesting lowers the cost basis. An investor harvests a capital loss by selling an investment with a cost basis of $30,000 when the price drops to $25,000. If they use the resulting capital loss of $5,000, cost basis of $30,000 minus sale price of $25,000, to offset the same amount of capital gains, they could lower this year's tax bill by $750. This assumes that their tax rate on long-term capital gains is 15%, $5,000 times 15% equals $750. In this example, tax loss harvesting has worked this year, but the tax savings of $750 is not necessarily permanent over the long term, because harvesting the capital loss has lowered the cost basis. As follows, the logical next step for the investor is to reinvest the $25,000 from the asset sold at a loss into a new security, which now has a lower cost basis of $25,000, down from $30,000. If the value of the new investment increases to $30,000 by the time the portfolio is liquidated, sold for cash, the investor will have incurred a capital gain of $5,000, due to the lower cost basis of $25,000, and the tax savings of $750 this year will be wiped out on a future tax bill, assuming their tax rate stays the same. However, if the value of the new investment increases above $30,000 to $35,000, then the investor will have lost money, despite the value increase. The reason is that the capital gains bill at liquidation will be calculated by subtracting the sale price of $35,000 from the lower cost basis of $25,000, for a capital gain of $10,000, which will be taxed at 15% for a total due of $1,500, twice the amount of taxes saved by harvesting the loss this year. Of course, if the new investment drops even further, instead of increasing, there are additional opportunities for tax loss harvesting, but buying losing investments should never be the objective. The caution for investors is that, from the time the capital loss is harvested until the tax bill comes due at portfolio liquidation, tax rates can change, personal income can go up or down, and the market can fluctuate, but taxes on capital gains will always be calculated on the cost basis of the investment. The fact that tax loss harvesting automatically lowers the cost basis could make the strategy deliver no benefit, or even create a loss, as in the examples above. Short-term versus long-term tax rates. Whenever a capital gain or a capital loss is realized, it is classified by the IRS as either short-term, on assets held for less than a year, or long-term, on assets held for more than a year. From a tax loss harvesting perspective, the most important short-term, long-term considerations are, all decisions about tax loss harvesting must take into consideration that tax rates are much higher on short-term capital gains than on long-term capital gains. Short-term capital gains are taxed as ordinary income at the marginal tax rate, which can be up to 37%, depending on income bracket. For most individuals, long-term capital gains are taxed at a rate of 15% to 20%, depending on income. For investors with income tax rates higher than their long-term capital gains tax rates, it might make sense to use capital losses to offset income rather than capital gains. For investors with income below certain levels, $40,400 for single filers or $80,800 for married couples filing jointly, capital gains are taxed at 0%. Allowances and restrictions on tax loss harvesting. Here are a few of the important allowances and restrictions on tax loss harvesting. TLH annual tax deduction limit of $3,000. There is an annual limit of $3,000 on tax loss harvesting for income tax deductions. A taxpayer may only deduct up to $3,000, $1,500 if you are married and filing a joint return, or your total net loss shown on line 16 of your Form 1040, Schedule D. Any total net loss on line 16 that is not used in the current tax year may be carried forward. No expiration date on capital losses. In the example above, the investor can use their capital loss of $5,000 dollar for dollar to offset their entire capital gain of $2,000 this year, and the remaining capital loss balance of $3,000 can be carried over to offset future capital gains, or income, until it is used up. There is no expiration date. In fact, even if the investor had no gains to offset that year, any capital losses they decided to harvest would carry over to future years until they are needed. Losses must first offset gains of same type. Another important consideration is that losses of one type must be used first to offset gains of the same type. Short-term capital losses must be used first to offset short-term capital gains. Long-term capital losses must be used first to offset long-term capital gains. Fortunately, if losses in one category exceed gains in the same category, then the remaining losses can be applied to gains in the other category. Of course, due to the large difference in tax rates, the most profitable way for most investors to apply tax loss harvesting is to use short-term losses to offset short-term gains. The wash-sale rule of all the restrictions on tax loss harvesting, the wash-sale rule requires the most planning. This is how it works. Most investors who use tax loss harvesting to lower their taxes want to maintain their level of exposure to the sector in which they took capital losses. Although reinvesting after realizing capital losses is allowed, investors must be careful not to violate the wash-sale rule, or the IRS will disallow the offset of capital gains. Here are the most important considerations for investors who want to stay both invested and compliant. 60-day waiting period. To prevent investors from gaming the system to get a tax break, the tax code prohibits investors from deducting capital losses on what the IRS calls wash sales, i.e., using a capital loss for tax loss harvesting and then repurchasing the identical security, or a substantially identical security, within 60 days of the sale that generated the capital loss. This means that investors must refrain from purchasing an identical or substantially identical security, or even an option to buy such securities, for 30 days before and 30 days after the capital loss is realized. Stock bonuses and ESPPs. In addition to options, investors need to be aware that the vesting dates of stock bonuses or the purchase dates in employee stock purchase plans (ESPPs) could possibly trigger violations of the wash-sale rule. Wash-sale rule applies to all accounts. It is also important to remember that the wash-sale rule applies to all trades under the investor's or the couple's social security numbers, which means that it applies to all their tax-deferred accounts, too. This means that an investor will trigger a wash-sale violation if they sell a stock in their brokerage account and buy the same stock in their IRA account within the 60-day waiting period. For married couples filing jointly, spouses are not allowed to use each other's accounts to get around the wash-sale rule. IRS-compliant replacement securities. Financial experts caution that the IRS wash-sale rule does not clearly define what would make a replacement security, substantially identical to the one sold to harvest a capital loss. With limited guidance from the IRS, investors trying to avoid wash-sale violations always have to consider the degree of overlap with the original investment. To maintain exposure to the industry of the security sold at a loss, within the 60-day window but without violating the wash-sale rule, one of the options for investors is investing in an exchange-traded fund (ETF) or a mutual fund that targets the same sector. Sitting on the sidelines can be costly. The wash-sale rule is cited by critics as a reason that many investors should think twice before attempting tax loss harvesting. Markets can move a lot in 60 days, and if an investor hasn't found an IRS-compliant replacement security, the profits they miss by sitting on the sidelines with insufficient investment in a hot sector could be greater than their TLH tax savings. Cryptocurrency and the wash-sale rule. Although cryptocurrency trades must be reported on tax returns as capital losses or capital gains, the IRS still considers cryptocurrency a property rather than a security as of July 2022, so the wash-sale rule does not apply. In the crypto market, an investor could do exactly what the wash-sale rule disallows for securities: sell cryptocurrency at a loss, buy back the same cryptocurrency without observing the 60-day waiting period, and then use the capital loss to offset capital gains. However, according to the Wall Street Journal in June 2022, as the U.S. Congress considers options to regulate the crypto market, the classification of cryptocurrency as a property may change. When tax loss harvesting works, the rationale for the tax postponement is that $1 today is worth more than $1 in the future, especially if the money saved on taxes this year is wisely reinvested and builds more wealth than the amount of any future tax bill at liquidation. When tax loss harvesting works as planned, the reinvested tax savings can drive the growth of a portfolio, even if the taxpayer makes no further contributions to the account. As mentioned above, both advocates and critics agree that tax loss harvesting is appropriate only for certain taxpayers in certain scenarios. The general guidelines include anyone with a taxable investment account and taxable income over the limits set by the tax code, as long as they have a fairly long investment horizon. In all scenarios, it is important to remember that tax loss harvesting does not permanently eliminate the requirement to pay taxes on capital gains, it only postpones it. As soon as the taxable account is liquidated, taxes are due on any capital gains, and the tax rate of the liquidation date applies. Fintech cuts transaction and administrative costs whenever trades are executed, including tax loss harvesting trades. Costs hit the account, both transaction costs for commissions and bid-ask spreads, and administrative costs for trade execution and regulatory filings. For years, critics of the widespread implementation of tax loss harvesting have argued that the TLH was appropriate only for larger accounts, both institutional and individual, where these costs are a smaller percentage drag on the portfolio. On the other side of the debate, a 2020 study conducted by the MIT Laboratory for Financial Engineering made the point that recent advances in financial technology, fintech, and the overall decline in computing costs have lowered, or even eliminated, the transaction and administrative costs that often used to wipe out the benefits of TLH tax savings for small investors. Now that fintech, especially at robo-advisors, has removed the cost barrier, the MIT analysts argued that tax loss harvesting has become practical for small accounts as well as large investors, and that fintech has the potential to drive TLH the same way it stimulated the growth of index funds and the options market.
When tax loss harvesting doesn't work, critics argue that pro-TLH theories assume ideal conditions for factors that are highly unpredictable in the real world. For example, postponing tax payments works only if tax rates, for both capital gains and the individual taxpayer, remain at the same level, or drop, and tax rates can never be predicted, especially over the lifetime of most investment portfolios. When tax loss harvesting backfires, the taxpayer can wind up with a future tax bill that is far higher than any profits from reinvested tax savings. Critics of the widespread use of tax loss harvesting also argue that small investors do not have the large, frequent capital gains that make TLH profitable for large investors, so capital losses might just accumulate indefinitely without lowering taxes. In fact, a frequently cited study published in the Financial Analysts Journal found that 40% of what determines how profitable TLH is to small investors is driven by uncontrollable factors in the return environment, and the remaining 60% of the variation is driven by differences in individual investor profiles, income, tax rates, cash contributions, liquidations, percentage of income offset with losses. For this reason, the analysts on this study advocated a case-by-case approach to tax loss harvesting, especially for average investors. TLH should be tailored to individual tax and income profiles, exactly as investment advisors do when they match asset allocation and risk profile to each investor's investment objectives and time horizons.
Does tax loss harvesting cancel tax obligations? Tax loss harvesting (TLH) does not cancel tax obligations. TLH only postpones the tax bill, in the same way that tax-deferred accounts do. What is the point of tax loss harvesting? If executed correctly, tax loss harvesting allows investors to lower their current tax bill, rebalance their portfolios, and keep more money invested. What is the wash-sale rule? The wash-sale rule is an IRS regulation that prohibits investors from using a capital loss for tax loss harvesting if the identical security, a substantially identical security, or an option on such a security has been purchased within 60 days of the sale that generated the capital loss, 30 days before and 30 days after the sale. What is the difference between short-term and long-term capital gains? The most important difference is that the tax rate on short-term capital gains, on assets held for less than a year, is much higher than the tax rate on long-term capital gains, on assets held for more than a year. What is the tax loss harvesting process? The three steps in the tax loss harvesting process are, 1. Selling securities that have lost value, 2. Using the capital loss to offset capital gains on other sales, 3. Replacing the exited investments with similar but not too similar investments to maintain the desired investment exposure. The bottom line: tax loss harvesting is the strategic approach to making the most of capital losses. Due to tax treatment of gains and losses, taxpayers may find it favorable to time when they sell securities at a loss and how they net this activity against favorable investment gains. Tax loss harvesting also strongly relates to wash-sale rules, which stipulate restrictions on benefits and treatments of selling a security and rebuying it within a specific window. A complete guide to tax loss harvesting with ETFs. Successfully building a wealth-generating portfolio involves more than just picking the right investments. Smart investors also pay attention to how gains and losses impact their bottom line concerning taxes. Tax loss harvesting can be a useful tool for managing short and long-term tax liability. Incorporating exchange-traded funds (ETFs) into a tax loss harvesting strategy offers certain advantages that may prove valuable to investors. Key takeaways: tax loss harvesting is the selling of securities at a loss to offset a capital gains tax liability in a very similar security. Using ETFs has made tax loss harvesting easier since several ETF providers now offer similar funds that track the same index but are constructed slightly differently. Tax loss harvesting can be a great strategy to lower tax exposure, but traders must be sure to avoid wash trades. Tax loss harvesting explained. To understand what the benefits of tax loss harvesting are, it's important first to be aware of how investment gains are taxed. Federal capital gains tax applies when you sell an asset for a profit. The short-term capital gains rate comes into play when you hold an investment for less than 1 year. Short-term gains are taxed at ordinary income tax rates, with the maximum rate for high-income investors topping out at 37%. The long-term capital gains tax applies to investments held longer than 1 year. For the tax year 2020, the rate is set at 0%, 15%, or 20%, based on the individual investor's tax bracket. Tax loss harvesting is a strategy designed to allow investors to offset gains with losses to minimize the tax impact. Harvesting a loss involves selling off an asset that's underperforming and repurchasing it after a 30-day window has passed. In the meantime, you would use the proceeds from the sale to purchase a similar investment. The net result is that you're able to maintain roughly the same position in your portfolio while generating some tax savings by deducting the loss from your gains for the year. The wash sale rule. The wash sale rule dictates when a tax loss can be harvested. Specifically, when you sell a security at a loss, you cannot purchase one that is substantially identical to replace it within 30 days before the sale and 30 days after it's complete. If you attempt to include the loss on your tax filing, the Internal Revenue Service (IRS) will disallow it, and you won't receive any tax benefit from the sale. The IRS does not offer a precise definition of what constitutes a substantially identical security, so navigating this rule can be tricky. Generally, stocks offered by different companies wouldn't fall into this category. There is an exception, however, if you're selling and repurchasing stock from the same company after it's been through reorganization. Harvesting losses with ETFs. Similar to mutual funds, exchange-traded funds encompass a range of securities, which may include stocks, bonds, and commodities. ETFs typically track a particular index, such as the Nasdaq or S&P 500, Standard & Poor's 500 index. The primary difference between mutual funds and exchange-traded funds lies in the fact that ETFs are actively traded on the stock exchange. Exchange-traded funds offer an advantage when it comes to tax loss harvesting because they make it easier for investors to avoid the wash sale rule when selling off securities. Because ETFs track a broader segment of the market, it's possible to use them to counteract losses without venturing into identical territory. For instance, let's say you sell off 500 shares of an underperforming biotech stock at a loss, but you want to maintain the same level of exposure to that particular asset class in your portfolio. By using the proceeds from the sale to invest in an ETF that tracks the larger biotech sector, it's possible to preserve asset diversity without violating the wash sale rule. You can also use ETFs to replace mutual funds or other ETFs as long as they're not substantially identical. If you're unsure whether a particular ETF is too similar to another, you can look to its index for guidance. If the ETF you're selling and the ETF you're thinking of buying both tracks the same index, that's an indication that the IRS may deem the securities too similar. Aside from their usefulness in tax loss harvesting, ETFs are more beneficial compared to stocks and mutual funds when it comes to cost. Regarding the fees, exchange-traded funds tend to be a less expensive option. They're also more tax efficient in general because they don't make capital gains distributions as frequently as other securities. Tax implications. From a tax perspective, using ETFs to harvest losses works best when you're trying to avoid short-term capital gains tax since the rates are higher compared to the long-term gains tax. There is one caveat, however, if you plan to repurchase the same securities at a later date. Doing so would result in a lower tax basis, and if you were to sell the securities at a higher price down the line, any profits you realize would be considered a taxable gain. The same is true if the ETF you purchase goes up in value while you're holding it. If you decide to sell it off and use the money to invest in the original security again, that will generate a short-term capital gain. Ultimately, you'd be deferring your tax liability rather than reducing it. Tax loss harvesting limitations. There are certain guidelines investors must keep in mind when attempting to harvest losses for tax purposes. First, tax loss harvesting only applies to assets that are purchased and sold within a taxable account. It's not possible to harvest losses in a Roth or traditional IRA, which offers tax-free and tax-deferred avenues for investing. A second limitation involves the amount of ordinary income that can be claimed as a loss in a single tax year when no capital gains are realized. The limit is capped at $3,000, or $1,500 for married taxpayers who file separate returns. If a loss exceeds the $3,000 limit, the difference can be carried forward in future tax years. The IRS also requires you to offset gains with the same type of losses first, i.e., short-term to short-term and long-term to long-term. If you have more losses than gains, you can apply the difference to gains of a different type in that scenario. Notes that tax codes are subject to change in any given year. Many analysts and tax professionals anticipate changes to the tax code that may have a significant impact on the practice of tax loss harvesting. There is a possibility that new provisions and proposed changes to the highest bracket tax rate would include the tax year 2021, which could reduce the benefits of tax loss harvesting soon. The bottom line, tax loss harvesting with ETFs can be an effective way to minimize or defer tax liability on capital gains. The most important thing to keep in mind with this strategy is correctly observing the wash sale rule. Investors must be careful in choosing exchange-traded funds to ensure that their tax loss harvesting efforts pay off. How to avoid violating wash sale rules when realizing tax losses. Tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given tax year. Tax loss selling involves selling a security that has experienced a capital loss in order to report it as a capital loss when filing yearly income taxes, and thus lower or eliminate any capital gain that may be realized by other investments. In order to successfully realize the loss for tax purposes, you have to take the step of liquidating the position during the tax year. Any unrealized loss on an investment cannot be deducted from your income taxes. Sometimes an investor will decide to replace that security with a similar security, allowing them to maintain a consistent, optimal asset allocation and achieve their desired returns. If you take this approach, it is important to be mindful that you do not accidentally trigger a wash sale in your investment account. Key takeaways. Wash sale rules prohibit investors from selling a security at a loss, buying the same security again, and then realizing those tax losses through a reduction in capital gains taxes. Tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given tax year. Investors may be able to claim up to $3,000 in capital losses per year in order to offset their taxable income, if they are married filing jointly. A common strategy for avoiding violating the wash sale rule is to sell an investment and buy something with similar exposure. What is a wash sale? A wash sale occurs when you sell or trade stock or securities at a loss and within 30 days of the sale, either before or after, you purchase the same, or a substantially identical, investment. The wash sale rule is a regulation established by the Internal Revenue Service (IRS) in order to prevent taxpayers from being able to claim artificial losses in order to maximize their tax benefits. When a wash sale occurs in a non-qualified account, the transaction is flagged and the loss is added to the cost basis of the new, substantially identical, investment you purchased. If you continue to trade the same investment, the loss gets carried forward with each transaction until the position has been fully liquidated for more than 30 days. The same rules apply if the spouse of the individual that sells the security, or a company controlled by that individual, purchases the same or substantially equivalent securities within the 30-day timeframe. In addition, your holding period for the new stock or securities for designating whether or not the investment will represent a short or long-term capital gain includes the holding period of the stock or securities that were previously sold. Investments subject to wash sale rules. The wash sale rule applies to stocks or securities in non-qualified brokerage accounts and individual retirement accounts (IRAs). The sale of options at a loss and the reacquisition of identical options within a 30-day timeframe would also violate the wash sale rule. The IRS provides guidelines about what is considered a substantially identical investment and thus may trigger a wash sale violation. In IRS Publication 550, entitled Investment Income and Expenses, including capital gains and losses. A substantially identical investment can include both new and old securities issued by a corporation that has undergone reorganization, or convertible securities and common stock of the same company. When an investor holds several different investment accounts, wash sale rules apply to the investor, rather than to a specific account. The IRS requires that brokers track and report any sales of the same CUSIP number in the same non-qualified account. However, investors are responsible for tracking and reporting any sales that occur in all other accounts that they control, including any accounts belonging to their spouse. Offset capital gains through tax loss selling. While some investors turn their attention to tax loss selling towards the end of the calendar year, it is possible to use this strategy throughout the year to capture tax losses through rebalancing or replacing positions in your portfolio. Capital losses are used first to offset other taxable capital gains. After this, up to $3,000 per year can be used to offset other taxable income for an individual filer or married couple filing jointly, up to $1,500 for married filing individually. For example, if an investor realizes $5,500 in long-term losses during the year, at the time that they file their income taxes, they can use $2,000 of those losses to offset the taxes on other capital gains and $3,000 to offset the taxes on their ordinary income. If this investor's long-term capital gains tax rate is 20% based on their income and their effective federal income tax rate is 25%, using this strategy the $5,500 loss can be reduced by $1,150, depending on the state they live in. The investor may also be eligible for a reduction in their state taxes. The remaining $500 in capital losses can be carried forward to future tax years. Unfortunately, losses cannot be transferred at death. Strategies for avoiding wash sales. There are strategies for avoiding wash sales while still taking advantage of taxable gains and losses. If you own an individual stock that experienced a loss, you can avoid a wash sale by making an additional purchase of the stock and then waiting 31 days to sell those shares that have a loss. A potential drawback of this strategy is that it can increase your market exposure to a given sector and could potentially increase your risk. In this same situation, an investor may decide to liquidate the holding, recognize the loss, and then immediately buy a similar investment that will also satisfy their investment goals or portfolio allocation. For example, an investor may decide to sell their stock of the Coca-Cola Company (Co.) and then immediately purchase a similar investment of PepsiCo, Inc. (PEP). Similarly, an investor may decide to sell their shares of the Vanguard 500 Index Fund (VFIAX) and replace them by purchasing shares of the Vanguard Total Stock Market ETF (VTI). Correction: January 20, 2022. The offset amount for individual taxpayers was incorrectly specified in a previous version of this article.
Again, an important point in December, particularly in this time frame in December, is to be aware of tax loss selling and harvesting and the selling pressure that's going to put on stocks that are significantly down for this year. So if you've got a stock that's significantly down for this year, it may be vulnerable to tax loss selling or harvesting, which means whoever owns that may sell it just to take advantage of the tax loss on their taxes for this year, irregardless of whether they like the stock or not, or think it has a long-term, potential, whatever. They're going to sell it now to take advantage of the tax loss. So be careful with stocks that are significantly down for the year. In the past, we talked about cheap value stocks that are significantly down. They're close to their 52-week lows. My warning in December is to be careful with those, because they potentially could significantly decline even more going into the end of December due to tax loss selling and harvesting. So again, be careful with those that are down significantly for the year at this time. Now, once we get into early January, and I'll talk about that more towards the end of the year, that changes significantly. We'll talk about how that reverses into early January. And again, I'm working on videos to explain in more detail what tax loss harvesting is, how it works. Also, what's the wash sale rule? How does that work? And then again, all this month we'll talk about the implications that has on our trading strategies. And again, I just wanted to bring it up now that be careful with your shopping list in particularly early December. Is I wouldn't buy anything that was significantly down for the year that might be vulnerable to significant tax loss selling at this time, because you can wait till the end of the month, and when it bottoms going into next year may give you a better opportunity. So I hope that helps. Again, I'll throw my financial Ellen Krantz, and we're gonna have more detailed videos about tax loss harvesting and wash sale, but the answer is yes. You have to have sold before January 1st in order to take that taxable loss for 2022. Again, I'll go into more detail on that whole time frame and scenario. We'll also talk about potential Santa rally towards the end of the month. So a lot going on in December to talk about. So again, let's talk about the trends we see and how we're going to strategize to make money in this world of accelerated tapering, accelerated interest rate hikes, high inflation. How are we going to make money, and what else is going on? Again, I'll probably talk more about the wash sale rule next week, and potentially just to try to keep these videos a little bit shorter. Potentially in a whole separate video we'll talk about the Santa rally, the wash sale rule, tax loss selling, etc. But we kind of expect that to wrap up this week, and then next week, and again next week we'll talk more about the Santa Claus rally. I'll put these articles in the description box, and you can read them at your leisure. And again, we can talk more about what that means next week. Just be aware, we expect the end of tax loss selling, profit taking this week, probably heavy this week, due to the wash sale rule, due to increased capital gains. Then we'll prepare for a Santa Claus rally. Part of that is, since we saw a downturn, have your shopping list ready, your value stocks, your quality stocks, the ones you've always wanted to buy. This week may be your opportunity. When they bottom, turn back up. It's great to be in a position where you've got a good value going into the Santa Claus rally, because assuming we have that this year, we expect a nice appreciation the last week of December through the first week of January. So this is potentially one of your best buying opportunities. We want to keep an eye on the seesaw. Is it a lockdown or reopening day? And buy the value stocks that are down on that day. Also a trend going on potentially is fund managers have to report their performance at the end of the year. They need to outperform the indices, otherwise their clients are just going to say, why am I paying you a fee when I could just put my money in the index and get equal or better return? So you may see some flow, again, some profit taking out of the ones that have been high flying this year. They're going to cash those out. I got my profit out of those. I need to show a return. So we may see some flow into higher reward opportunities. Been looking at the indices for biotech to see if we're going to start to get an upturn. They've been beaten up pretty severely. These are high risk, high reward opportunities. But they're catalyst based. You'll see in the list of top gainers, top losers on a given day, biotech stops probably the top of the top gainers, and there's one on the top of the top losers list. So it's a matter of picking the right one or guessing the right one, and a lot of that's catalyst based. And also we talked about small caps, again, higher risk, high rewards. We may see some money flow into these areas as fund managers try to outperform. Something to watch for. If we start to see an upturn in these areas, that tells us there's money flowing into those, and that then will fuel the Santa rally, fuel into next year. So I hope this all helps. Again, we expect continued tax loss selling, profit taking this week. Probably a downturn in the indices, probably a lot of chop though. We've also got the seesaw going on. People repositioning for next year because then they're going to go on vacation. So they're going to set their strategy for the end of this year, and then probably go on vacation. So please let us know in the comments below if you find all this information helpful, if you have any thoughts on any of these themes, trends, strategies, etc. In part 2, we will talk about the individual stocks that we want to put on our watch list for next week to take advantage of these strategies. So again, we hope you like this. Smash the like button so other of your fellow traders get the opportunity to see our information. We hope you'll subscribe if you're not already subscribed. Hit the notify button to get notified of our further videos. And we'll talk about individual stock picks in part 2 tomorrow. We hope that you found our video on what is tax loss harvesting and how does it work helpful. We hope that you benefit from all of this information, as well as our trading strategies for how to use this information in your trading career, succeed in your trading, make money in your trading. Also, as we mentioned, we will be doing subsequent videos on more detail about the wash sale rule, and also on a Santa rally. So we hope that you will choose to subscribe to our BeachBum Trading YouTube channel. Please hit the bell icon so you're notified when we release those additional videos with further detail on the wash sale rule and the Santa Claus rally or the Santa rally, and also additional trading strategies on how to combine your trading with tax loss harvesting, wash sale rules, and position for a Santa Claus rally in a given year. So again, we hope you like this information, find it beneficial. Please let us know in the comments below, in our free Discord, for which you can find an invite in the description box below, in our Facebook group, and or contact us via any of our social media sites, all of which you should be able to find links to in the description box below. So again, we hope you find all of this information about what is tax loss harvesting and how does it work beneficial to you. We hope that it will help you succeed in your trading career. Good luck and have a great trading week. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the BeachBum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.